Good evening. Good evening, everybody. Good evening, everybody. Thank you for joining. Just going to give it a couple of minutes while we give everybody an opportunity to join the live, but we will be kicking off very shortly. So please grab a drink, grab your coffee, get comfortable, and we're looking forward to tonight's expert webinar. For those of you who are on the live already who may not know me, my name is Vanessa Rafonja. I am the owner director of VA Property Sales and Lettings in Luton, an estate agency established for about 16 years now. Together with a fabulous team, we rent properties, manage properties, refurbish properties, and we sell properties. So we're looking forward to delivering a good webinar tonight all about mortgage finance, which is a very apt topic at the moment, considering the current market times and the mortgage rates. So hopefully you will take away a nugget or two, if not more, from our guest expert, Megan, who I'll introduce shortly. But like I said, I'm just going to give it, we always wait a couple of minutes to give the opportunity for a few people to join the Zoom. So I hope you're nice and comfortable. While we are waiting though for another 2 minutes before we start, 2-3 minutes before I start the webinar officially, it would just be nice if you could drop in the chat if you actually have a mortgage at the moment that is coming to an expiry, say within the next mortgage deal that you're currently on, that's expiring in the next, say, 6 to 12 months. If that's you, if you could drop a 1 in the chat, just been interesting to see kind of where we are as property owners with our mortgages, and what we're feeling and what we're thinking, given the current mortgage interest rates that we're facing with deals that are expiring. So if you drop a 1 in the chat if you have a mortgage that will expire in the next 6 to 12 months. Couple of 1s, yeah, a few 1s coming through. I think it's quite a daunting position, I think, for a lot of people whose mortgages are soon to expire, because if you've been on a 2-year, 3-year, possibly even a 5-year fixed rate mortgage, you probably know by now that the mortgage rate that you'll be looking at and facing in the next 6-12 months when your product expires will be substantially more than where you have been for the last few years. So the reason we put this webinar on tonight is just to educate, to inform, and to help our clients, the audience, see what's ahead and plan for good, good mortgage finance as best as possible. We've got people saying, clients saying that it's coming to an end in a few weeks' time. So it's all those things that we're all dealing with, and it can feel quite daunting, having to number crunch and decide what the best route is for you to go next, given where we are now. In terms of how this evening will run, I'll start the formality now, and we'll allow guests to join us and when they log through. But in terms of how the evening will run, so this is our final VA expert webinar for the year. It's something that we've been doing since the pandemic, actually. So since 2020, it was an idea that I kicked off when we were all locked down and housebound, to deliver information news to our client base and a wider audience as to what's going on, what's hot, what's not in the property market. And it's been received really well. And yeah, it's something that we're looking to carry on with, to bring the best of the property information market to yourselves. So tonight, how we start, we're looking for about maybe 75 minutes of your time. The webinar should last for. The running order for this evening is I will start with a brief market update, which is mainly around the Luton market, but there are some general market update points in there as well. So I'll kick off with a market update to give you an idea of where the Luton market's moving, where the property market is generally heading, in my opinion, through running the business and working with my team. After I've delivered the market update, I will then introduce our guest expert for tonight. I will actually read her professional profile so you understand exactly who it is that's sitting in front of us tonight and why she's qualified to talk to us about mortgage finance. After I introduce the guest speaker, I'll then, of course, hand the platform over to her, and then Megan will take the floor for the next approximately 30 to 40 minutes to deliver a presentation on the keynote topic of mortgage finance for tonight. whilst Megan is talking and giving us the great information that she has to deliver, if you've got any questions, if you've got any queries, please feel free to drop them in the chat while Megan is speaking, because at the end of the presentation, we will then have a Q&A session where we'll try to address as many of your questions or queries as possible. If you have anything about the general property market, again, drop that in the chat. I'll also be involved in the Q&A, and myself and the guest expert will do our best to answer the questions that have been put forward. If time permits, we'll open up the Zoom call to a handful of live questions, depending on the time, and then we will then look to round down after the Q&A. But do try and stay to the end. Like I said, it's about 75 minutes this evening, because we have a little free gift that we're going to drop into the Zoom call that we want to give you for attending tonight. So it'll be worth you staying, and there's a few little nuggets that we'll be dropping during the meeting as we go along this evening. So please, if you can, stay with us right to the very end. There's a few things coming up for you, which I think that you will benefit from, if not now, certainly into your property journey. So I will kick off. This evening with the market update. So in terms of how the market is moving at the moment, I'll start with the rental point of view. And when I'm talking prices now, I'll be talking more about the Luton rental market. So the property rental market at the moment in Luton is, and I think this does mirror for most of the UK, but certainly towards the south, is very, very, very strong. There is still a very high demand for rental properties from tenants, and unfortunately a low supply. Fortunate for landlords though, because what we're seeing is when there's more demand than supply, of course the rents are going up, and rents have been going up probably for the last 9 to 12 months now. Rents are just continuously rising every month, every quarter. To a degree, I feel in Luton it almost feels a little bit unsustainable, given the average household income. In Luton now, this is obviously property dependent in terms of its features, presentation, but in general, in Luton now, you're looking at, for a one-bedroom property on the rental market today, upwards of £850, £900 in most cases. For a two-bedroom, upwards of £1,100, £1,200. For a three-bedroom, upwards of £1,500, and then for a 4-5 bedroom, you're talking upwards of £1,700, if not more. Again, postcode specific and property quality specific, but those are the kind of rents that our local market is commanding at the moment. So it's very, very high. So what we're finding now in terms of the tenants who are renting, we're finding that you're having more adult families grouped together to be able to afford that type of rent. So typically where a nuclear family would rent a property for just themselves, you'll find that the family now might be incorporating a sister, a cousin, an adult in-law, somebody else, one or two other adults in their family circle into that tenancy, who's bringing in a household income in order to make that rent affordable. Because by the time they add the rent, the council tax, and all the utility bills, the outgoings in most cases can be upwards of £1,500, £2,000, depending on what the rent is, before they've even looked at their basic bills to survive. So we're finding tenants are grouping up in adult family groups in order to spread the affordability to afford to rent the properties. How long I think we can sustain such high rents, for me, is a massive question mark. We are seeing a massive drive from overseas international tenants. There's a various amount of different visas that are out on the market, the COS visa, different visas where you're seeing international people coming in from abroad. Again, they are fueling the price of rent because they're coming in without a UK footprint, or a very small UK footprint in most cases. So they have no choice really than to pay their rent 6 or 12 months in advance. And they're in a position to do that. And they're also, in a lot of cases, in a position to outbid and pay a little bit more, because they are so in need of those properties that they tend to overpay for the price. And they also tend to pay 6 to 12 months in advance to a landlord, which is quite appealing for a lot of landlords in terms of cash flow and security. So we're seeing a lot of international tenants coming through. They're driving the market in a different direction. So landlords are faced with various challenges and various choices when it comes to the rental market. In terms of how quick properties are renting out, sometimes literally my team are putting properties on the market within the hour, 2 hours. If that, we've literally got 20 people lined up to view the properties. Good properties are going very fast. Sometimes they don't even hit the market. We know who we've got qualified before we even bring that property to the market. And when I read wide, when I talk to other colleagues in different areas, they're telling me similar things about where they work. So this is mirrored pretty much across most parts of the UK. So it is a good, strong position for a landlord. But on the flip side, where properties are very high in rent and tenants are dishing out that sort of money, the expectation for the quality of your property is very, very high. So if you're commanding 950 for a one bed, the tenant's expectation is that property is in good order. You have good heating system, the decor is clean, the kitchen is functional and not shabby. So landlords again are having to step up their game if they want to achieve those higher rents because it's a lot of money and tenants are now actually demanding for the value that they're paying. So we have to also bear that in mind as property accommodation providers. On the flip side, on the sales market, I think it's probably no surprise that we're seeing the sales market struggle quite a bit, and it has been for the last 12 months with the impacts of the high interest rates, which our expert will go on and talk a lot more about in detail. Obviously, the cost of living that's impacting the power of the pound and spending. So we are seeing the sales market slow down. Where we used to see an average of from listing a property for sale to completing of 12 weeks, you're now looking on average of nearly 20 weeks. Things are moving slower, surveys are harder, valuers are going out and down valuing properties. So the premium pricing that we saw during the pandemic time of house valuations, that's gone. Your property has to be valued realistically, still achieving a good price, but we're definitely seeing the premium cool off the market. And we're seeing that when the banks send out their valuers to do the surveys, they're very, very conservative, probably more conservative than ever, and they're knocking the valuations down. So selling a property in this current time is challenging. So you have to be prepared to be on the market, waiting for that buyer, I would say, for a lot longer than, we were a couple of years ago. I even read some stats earlier this morning that said the Lloyds Banking Group, who own Halifax, who's arguably, I think, the biggest mortgage provider in the UK, they're expecting the average house price to drop 4.7% this year. And I think from a real-time estate agency point of view, we are seeing that. We are having to bring down a lot of the properties that we've listed on the market this year. We're having to knock them down by a couple of percent to get those properties moving, to get the buyers interested in even picking up the phone to make an inquiry, let alone getting them to come and have a viewing. So we're seeing a lot of market dynamics in the sales environment struggling. So if you're looking to sell or you're thinking about selling in the new year or before this year ends, you have to be open, you have to be realistic to that valuation, you have to factor how long it may take you to sell that property in terms of any outgoing costs if you've already moved on, or if the property is empty because it was a rental property. You have to put these things into consideration because that is the real dynamics of the market that we're working with at the moment. But of course, if you're a landlord, like I said earlier, it's happy days for you because you can command higher rents. But with interest rates moving so high, now as a landlord, and our expert will touch on this in detail, a lot of landlords now have to look or are looking at more creative ways to rent their property out to raise the rental return in terms of the yield that you get back. So where traditionally you'd buy a property and you'd rent it to a family, you're happy with the rental return, that might not work as easily anymore depending on your mortgage rate. So things like looking at properties that are more suited to HMOs. If you don't know what that means, that's houses in multiple occupancy where you're renting the property effectively as rooms. That will bring in a higher amount of rental income. From one property, if you have 6 rooms, all of a sudden you'll have 6 sources of income, so your yield will be higher. Yes, there are laws, there are compliance, there are licenses, but these are ways to increase how much that property plot can bring in for you. We're seeing a lot of landlords go down the short letting space. So we're all very familiar with Airbnb and Booking.com. That's becoming bigger and bigger for landlords, obviously subject to your mortgage provider's approval, but that's nightly rate renting. Again, you demand high premiums for short stays. So we're seeing a lot of landlords look at more creative ways of renting their properties out so that they can actually make the rental return that they need to service and satisfy that mortgage. So I think now as an investor, more than any time before, the very, very straightforward traditional buy a property, find a core family tenant, rent it out may not be the way that you should be looking to go down, especially if you're locking in an interest rate at 6.2, 6.4%. But like I said, our expert will talk about that in detail. So those are just a few little nuggets and opinions from my side at VA, working in the market, looking at the market, and working together with my team. I hope that's helpful for everyone. What I'd like to do now is move on swiftly to introduce and talk a little bit about our VA expert tonight, the lady that you've all come to listen to. She's the lady in the mortgage market. If you permit me, you may see my head down in my screen because I like to read my experts' professional profiles, so I do them justice, and you know exactly why they're here, qualified to sit and talk to us tonight on the chosen subject. So, Megan Willey is her name. Megan has been a mortgage and protection advisor since she graduated from university with a first-class degree in business and finance in 2018. Megan has always worked for national specialist brokers who focus on helping clients who don't fit the mold that high street banks will accept, whether that be portfolio landlords who own more than 10 properties, people with multiple income stream or credit issues. Megan is experienced in finding solutions that mainstream brokers often can't. At the beginning of 2023, Megan took the leap of becoming a self-employed broker under the Mortgage Experience brand so that she could have more control over the service that she offers and take better care of her client mortgage journeys, rather than having them passed to various administrators, which can be very stressful and is common practice with employed mortgage brokers. Megan brings a fresh and professional approach to her work, providing full mortgage and protection advice services from an initial free, no obligation call to hand-holding her clients every step of the way through the journey until completion. Whatever your circumstance, Megan's experience and knowledge means she can source the best deals for you across thousands of mortgage products. And being a whole of market, it means that Megan has access to deals that may not be ordinarily available on the high street. Megan can assist you whether you have a perfect credit history or you've been declined by a high street bank, whether you're a new investor or you're an experienced portfolio landlord, which is a specialist area for Megan, or even if you're a first-time buyer. Megan will leave no stone unturned to find you the best deal whilst making the process as stress-free as possible. And we all know, if you've ever gone through a mortgage process, how stressful that can be. So without further ado, ladies and gentlemen, thank you for listening. And I would like to present and hand over to our VA expert guest speaker of the night, Megan Willey. Over to you, Megan. Megan, you're on mute. If you unmute yourself first, you're on mute. We can't hear you. If you just give Megan a moment, I think she's just trying to unmute. Her Zoom can be a bit tricky sometimes. We're still seeing your mute button on. Are you unable to mute yourself, Megan? It's not unmuting. Oh, there you go. I think it's coming through now. Perfect.
Sorry, guys. I was trying to unmute myself, but because participants can't unmute themselves, that also applied to me, which wasn't very professional. So sorry about that. First and foremost, thanks so much, Vanessa, for the lovely introduction. I'm really pleased to be here tonight. So thank you all for joining us. I'm just going to share my screen and bring up a presentation for you, and then we will kick off. So just bear with me 1 second.
No problem, Megan. And just as a quick reminder, if anybody has any questions, any queries, as Megan is delivering her presentation, please drop them in the chat, because like I said, at the end of the presentation, we will go through as many Q&A as we can to help and give out information, whether it's mortgage, whether it's market. Please drop that in the chat. Thank you.
Here we go. So hopefully now the technical issues are out of the way and you can see my screen.
Perfect.
Yeah,
Perfect.
brilliant. Okay, here we go. So, as Vanessa mentioned, I'm a whole of market broker and I specialise particularly on buy-to-lets and portfolio landlords. So, I've tried not to heavily focus my presentation on one particular group of people, because I know that a few of you may be from different walks of life and you might be on different stages of your investment journey, but a lot of it will be geared slightly towards landlords, as I know that the majority of you will be from that background. So, in terms of what I'll be covering this evening, so I'll start with a brief overview, similarly to what Vanessa has done, of current market conditions, but more focused around the mortgage side of things. So not necessarily, as Vanessa has spoken about, average rentals, but more about the challenges that I'm sure all of you have been facing over the past 12 months in terms of mortgage rates and the knock-on effect that high rates has had. I'll then move on to current market predictions, and these will be from multiple sources that I've spoken to over the past few weeks. From there, I'll go through the different things that affects interest rates, that you're in an informed position moving forward, knowing that there's a few different factors that affect rates rather than just the base rate, which a lot of people seem to think is the only influence. After this point, I will move on to the different types of products out there, focusing specifically on the different types of rates, as I know that a lot of you will be interested in whether to opt for a fixed rate or a variable rate this time, and how those rates are beneficial for each type of customer. So I'll run through that with you as well. And then finally, the main part of the presentation will be on the different solutions available to you to try and remain profitable during this difficult time. So I'll be touching on some of the areas that Vanessa's mentioned, so some of the specialist finance positions in terms of properties and a few other bits and pieces as well. So I hope that you find it helpful. So let's start from current market conditions. So I know that I'm not going to be the first person, or this isn't going to be the first time you've realised that interest rates are really high right now. It's a really difficult market. The base rate has risen 14 times in a row, apart from the last base rate review. So it is a really difficult time. Now, just out of curiosity, how many of you have tried to remortgage in the past 12 months and noticed that the payments are a lot higher than what you signed up to 2 or maybe 5 years ago? Drop a comment in the chat if you've been in this position. So the knock-on effect of high interest rates is not only that monthly payments are higher, it's that it restricts borrowing quite heavily. So first and foremost, from a residential mortgage point of view, because interest rates are higher and the cost of living is higher, lenders then won't lend you as much because the mortgage payment is higher. Similarly, from a buy-to-let point of view, lenders determine how much you can borrow by something that's called the interest coverage ratio, the ICR rate. Now, that basically determines how much you're able to borrow on a buy-to-let mortgage on the basis of the rental income that you're achieving on that property. So they in plain terms, they stress test the rental income, and that gives a figure for how much you're able to borrow. Now, the stress testing has gone up from 3% about 2 years ago to anywhere between 5.5% to 9% with some lenders. So there's a massive difference between what you were able to borrow off the same rental income 12 months ago compared to what you were able to borrow now. And I speak to a lot of landlords. A lot of you may be sat listening to this thinking, yes, this is the position I'm in, where you've come off a 2-year fixed deal. You've gone to your broker and said, what else is out there for me? And they've turned around and said, right now, unfortunately, your rental income is no longer high enough to get a new mortgage of the size that you need. So that's the main impact of high interest rates for buy-to-let landlords. And it can be really difficult. But as I say, each lender offers different stress testing. So just because one particular lender has said that you can only borrow a certain amount, it is really important that you speak to a whole of market broker who can go out there and stress test with every single lender out there to make sure that you do know the absolute maximum that you are able to borrow, so you're not stuck on a variable rate with your current lender. Now, another point which Vanessa has touched upon earlier is that the market is quite slow in terms of sales. So what that means is that people who are forced into a position where they maybe want to sell because their property is no longer as profitable as it previously was, are in a position where if they try and sell, they might be taking 5–10% lower than what they actually want to sell the property for. So it can be quite difficult in knowing what to do, because on the one hand, the property is not viable right now. You're either breaking even or losing money, or secondly, selling the property, you might sell it at a loss. So it can be a really difficult position. And just to add one more stinger, another thing that has been hurting landlords over the past 12–24 months is the increased taxation on rental profit. Gone are the days where if a buy-to-let was owned in your personal name, you'd be able to offset the majority of the rental income that you've received against your tax bill. So you're being squeezed at both ends, and you know, both myself and Vanessa and everyone in the industry, including lenders, are aware of this. So because of that, lenders and brokers are trying to find innovative solutions to try and maintain some sort of profitability for you. So I'll get onto that towards the end of the presentation. Now, it's not all doom and gloom. As Vanessa has mentioned, there's an extremely high demand for rental properties in the majority of the country. So that's driving up rental prices, which is a good thing. And it also means that properties aren't empty for a long period of time, which at least can reduce the burden that a lot of you out there will be facing. At least if interest rates are high, you're not in a position where you can't find a property for months on end. So that's one positive aspect of the current market. Now, onto the current market predictions. Now, I must state before I go through these, no one has a crystal ball, myself included. If I did, you know, I'd be a very rich woman, but unfortunately, these predictions can change. And what I've found quite often over the past 12 months is that when I'm speaking to lenders, their finance teams and the people who are paid to predict risk and predict what's happening, their opinion on what's going to happen changes quite frequently. So these predictions are based on conversations that I've had in the past 2 weeks with 4 or 5 of the largest lenders in the UK. So firstly, the current opinion is that there will be potentially another 0.25% base rate increase before the end of this year. This one is quite a contested point because 1 out of the 5 lenders that I've been speaking to, their team thinks the base rate won't rise again. So no one knows for sure, but right now the consensus is it looks like it will rise at least one more time. Now, after this year, people are thinking, and experts in this field now are predicting that the base rate will remain high at around 5% until the end of 2025. That necessarily doesn't mean that mortgage rates will remain that high. So in a moment, I'm going to talk you through the different influences of factors that drive mortgage interest rates other than just the base rate. And that will explain how there can be a difference between the mortgage rates being offered to you and the base rate at the time. So as it mentions on the slide there, the current predictions are that in between the next 18 to 24 months, the base rate should reduce to below 4%. Not the base rate, sorry, the average mortgage interest rate. That will depend on your circumstances, like how much equity you've got in your property, whether you can go to a high street or a specialist lender, and there's a few other factors. But as an average, that's the consensus right now, is that the average rate will be below 4%. What does everyone think? Does everyone think the base rate will rise at the end of this year? Anyone who's been paying attention, if you think that it's going to go up or it's going to remain the same, drop it in the chat box. I'll be interested to hear your thoughts. And then finally, at the end of the next 12–18 month period, whatever it is that mortgage rates do come back down, every single lender right now is predicting a huge spike in market activity. I'm speaking to a lot of residential buyers and buy-to-let investors at the moment who are of the opinion that right now they just want to wait. So say a family who have bought the first house, they've lived there for a few years, and they're now in a position where they're probably outgrowing it and it's time to size up. A lot of people right now are waiting to do that. So there's going to be a lot of pent-up activity where people are desperate to move, and the moment that the rates come down, suddenly it's going to go back to the times where it's difficult to get a viewing on a property without it already being sold. That's the predictions right now. How accurate that is, we won't know until it happens, I suppose, but it's encouraging that as long as we weather the storm at the moment, then in the next 18, 24 months, things should get better and house prices should start to recover slightly. There should be more demand for house prices, and it should be a better market for people buying and selling. Now, this final point is in reference to the new normal. You've probably heard the new normal mentioned quite a lot in relation to COVID. I hear it often mentioned to me by lenders. They often say this is the new normal. And what they mean by that is that, as you'll see on the graph here, this is a graph of the base rate since 1976. And this area here is how low the base rate has been for the past 15 years since the last financial crash. So although a lot of people, it feels like the base rate now is extraordinarily high, and this is a complete anomaly, and the base rate will go back down to 2% levels, the current predictions, the history, everything shows that actually the past 15 years were the anomaly. And now interest rates are just going to be higher for a prolonged period of time. Hopefully, as I've just mentioned, they will come down lower than where they are at the moment. But I think higher interest rates, 3, 4, 5%, are where they're going to stay for the foreseeable future. Now, as you can see, right now, where the base rate is, it's not abnormal compared to market history. However, what is abnormal is current house prices. So everyone on this webinar will know that house prices today are worth a lot more than what they were when the last time mortgage rates were 10, 12, 15%. I often hear a lot of people saying, yes, in the 80s, interest rates were 18%. Now 5% is nothing. And you're right, 18% is a lot higher a lot higher than 5%. But when your house is valued at 270,000 compared to 50,000, and the mortgage that you've got is 240,000 compared to 40,000, that interest rate makes a big difference. So this is why right now a lot of people are feeling the pinch more than they would if the borrowing was less. Now, I'm just going to talk you through a few of the factors that determine mortgage rates. So firstly, as we've just mentioned, the Bank of England base rate has an influence. And what influences the base rate is inflation. So when inflation is high, the Bank of England increase the base rate to try and restrict market activities, reduce the spending in the economy, so that then inflation will come down. So that's one factor. The bigger factor that actually determines mortgage interest rates is swap rates. You might know them as SONIA rates. Basically, to not go into too much of the financials and complicated terminology surrounding swap rates, it's basically the rate at which banks lend to each other. So when you go and apply for a mortgage, no matter that's with a high street bank or a specialist lender, 9 times out of 10, the bank that you're applying to will have borrowed that money from a different bank at a certain rate of interest. Now, the rate of interest agreed on swap rates at the moment is typically lower when you go for a longer term swap rate, say a 5-year. Now, for example, right now, a 5-year swap rate as of today was 4.56%, and a 2-year swap rate was 4.98%. So that difference there explains why, especially in the residential lending space, 5-year fixed rates are more competitive than 2-year deals, because the banks are predicting that the rates will decrease and over the next couple of years. And if you go for a 5-year deal, they can afford to make a loss in the first 2 years, and then they will make that back in years 3, 4, and 5. So the swap rates is a really important factor that drives mortgage rates in the market. Now, another factor that determines mortgage rates is demand for products. So what lenders offer you in terms of mortgage products is not always based on what's competitive and what their costs are. A lot of the time, if they're inundated with applications and they're struggling with lender capacity, they will then rise their interest rates to stop people from applying. So just because the market activity is getting better, just because the base rate goes down, it doesn't necessarily mean that lenders' rates will come down, especially if a lender is really competitive for a long period of time. what we often see is on a sourcing system which ranks mortgage products from most competitive to least competitive, the most competitive lender might be there for 2 or 3 weeks offering the best rates out there. And then at that point, for no reason other than capacity, they will then increase their rate significantly to pretty much stop applications whilst they catch up. Now, on this section, I'm going to run through the types of products out there. I think that it's really important that you're all aware that there are other options out there apart from just fixed rates. I think traditionally, whilst rates have been low, it's been common practice for a lot of people to just go from one fixed rate to the next without really considering what other types of rates are out there. So firstly, the most well-known and popular type of product out there is the fixed rate. Now, a fixed rate is set for a period of time, typically 2 years, 3 years, or even 10 years. And during that time, your payments can't change. The benefit of that is that if the market increases, if rates go up, you're protected from that and your monthly payment cannot change for a period of time. The downside of a fixed rate is that if rates come down, you're typically tied into that product. And if you want to repay that mortgage and switch to a different product, a lower interest rate, for example, then you would have to pay an early repayment charge to come out of it. And typically they are calculated by a percentage of the mortgage balance. So they can be quite hefty charges if you've got a couple of $100,000 on a mortgage. So first and foremost, if you are someone who likes stability and wants to know exactly what you're paying every month, then as I'm sure you have been doing since you took out a mortgage, go for a fixed deal. The main decision that you need to make is how long you want to fix the interest rate for. Now, with residential mortgages, as I mentioned previously, 2-year fixed rates are higher right now than 5-year deals are. So if you want the cheapest payment overall, then a 5-year fixed rate will reduce your outgoings more than a 2-year fixed rate will. However, if you know that you're the type of person who, when they start seeing articles about mortgage interest rates coming down, won't be able to resist going on to comparethemarket.com or speaking to a broker or finding out about rates in some way, then and would be annoyed that you've missed out on the opportunity to reduce your mortgage payment, then you should be tempted to go for a 2-year deal over a 5-year deal. If you're someone who would rather miss out on the opportunity or miss out on the gamble of switching onto a better deal in 2 years' time, and would just like to know where you stand for a longer period of time, then a 5-year fixed rate would be more suitable. Now, it's difficult for me to give any more information about what's suited for a particular person because it's really important that you go through a review with an advisor. So speak to your broker, get in touch with someone who's a qualified advisor who deals with the whole of the market, and they'll be able to go into a lot more detail than I have just now about what type of rate would be best for you. Now, moving on from the fixed rates, you've got tracker rates. Now, tracker rates simply track the Bank of England base rate. So they might be, say, 0.2% above the base rate. So if the base rate goes up, your mortgage rate and therefore your mortgage payment will go up. And if it goes down, your mortgage rate and therefore your mortgage payment will go down. If you're of the opinion and you believe that we've hit the peak with interest rates and that the base rate will go down, then a tracker rate could be a good option for you right now. Some tracker rates also come without any early repayment charges as well. So what that means is that you can go for a tracker rate, you can take a bit of a gamble on interest rates, betting that they're going to go down. And then if worst case scenario, they don't go down, you can then switch onto a fixed product without having to pay any early repayment charges to do that. So it can be quite a good way of remaining flexible and taking a chance if you're someone who can afford the payment to vary slightly. Finally, we're going to move on to the discounted variable rate. Now, not many people have heard of this type of product, and I think it's probably because it's not often publicised by the main banks. It's traditionally a product that's offered by building societies. There are a few specialist lenders that offer them as well, but I'd say typically the main lenders that offer discounted variable rates are your smaller building societies. Now, the way that discounted variable rates work is that instead of tracking the base rate, the building society or the lender will give you a discount of their standard variable rate. And the standard variable rate is the rate that you go on to when you come out of a fixed term. So I'd imagine people on this webinar, there might be some of you right now who are on the variable rate, have come out of a fixed deal and aren't sure what to do. And right now you'll be on a standard variable rate. A discounted variable rate gives you a discount off that variable rate for a set period of time, typically 2 years. Now, the benefit of a discounted variable rate is that because they're offered by building societies, and building societies typically try and keep the members happy, what they only tend to is, I can't say this in all circumstances, but building societies typically only pass on rate increases to their existing customers when they absolutely need to. So what we saw last year when the base rate was rising month on month is that a lot of the building societies absorbed a lot of those base rate increases for quite a long period of time, and those customers who were on discounted variable rates weren't passed on the higher interest rates. Similarly to tracker rates as well, a lot of building societies offer options where you can switch onto a fixed deal if the rate increases and you're not happy with that. So again, they can be slightly more flexible than a fixed rate. But as an easy rule of thumb, if you can only just afford the payments on a fixed rate, do not go for a tracker rate, because it's not worth the gamble. If looking at your budget, you could afford an extra £100, £200, even though you wouldn't want to pay it, if you can afford it and it wouldn't put you in financial difficulty, then at that point, consider a more flexible rate like a tracker or a discounted variable rate. Now, I hope that's been helpful in terms of types of products. As I say, it's really important that if you are coming up to the end of a product term and your mortgage is up for renewal, speak to a broker. They'll be able to give you more information than that and talk through specific rates available to you based on your situation, how much equity is in your property and your mortgage size. So at this point of the presentation, I'm going to move on to how you can reduce the impacts of high interest rates. Now, unfortunately, there's no one-size-fits-all solution. There's no bank that you can apply to that will give you a much better interest rate than all the others. But there are a few things that you can do to reduce the impact, which I hope will be helpful for some of you. So firstly, if you are in financial difficulty and you're struggling to pay for the mortgage, then first and foremost, if you haven't done so already, contact your existing lender and ask to extend the term or switch onto interest only. The government brought in the mortgage guarantee recently for this, where you can switch on to interest only or extend the term and it won't impact your credit profile. Previously, before this came in, if you were to enter into an arrangement with your mortgage provider and temporarily switch on to interest only, that would have a negative impact on your credit profile. Now it doesn't with most lenders. So if you are in difficulty, speak to your lender, check with them that it won't affect your credit file, because some lenders who haven't joined up to the government scheme, it will. But lenders right now are doing everything they can to help borrowers who are struggling. Now, after you've done that, if you are an investor and you've got a buy-to-let portfolio, the best thing you can do at the moment is redistribute mortgage borrowing across your portfolio. And the reason for that is that there's much more competitive products at lower loan to value, which is the ratio between the mortgage balance and the value of the property. The lower the loan to value, the better the products that you can access. So instead of focusing on one property, sometimes you can access much better interest rates and therefore maintain profitability by remortgaging a few properties at the same time and divvying up the mortgage balance across multiple properties so that the loan to value is lower. To give you an example of that, one buy-to-let lender this week has introduced a 2-year fixed rate at 3.95% at under 65% loan to value. So if right now you're someone who's looking at their portfolio and thinking, I've got 1 or 2 houses where the mortgage balance is only 25% of the property's value, but I've got a couple more that I bought more recently where the mortgage balance is right up to 75% loan to value, now is a good time to redistribute that to make sure that you can access the more competitive deals. Now, that may not be an option for everyone. Not everyone has multiple properties with lots of equity in some of them, so I do appreciate that. One thing which lenders have introduced to try and mitigate the impact of higher interest rates and therefore higher stress testing is by introducing lower rate, higher product fee products. So if anyone has tried to remortgage a buy-to-let, especially more so than a residential, in the past few months, they'll have noticed that the most competitive deals they come across are typically deals that might have a 2%, a 3%, or a 5% product fee. And that's calculated as a percentage of the mortgage balance that you're borrowing. Now, the reason why lenders have done this is because they're able to offer you a lower mortgage rate, which then means that the stress testing that they do on your rental income is lower if the mortgage rate is lower. So although it can take you back slightly, listening to your broker tell you that the cheapest deal might include a 5% product fee. If you've got a mortgage of 200,000, that's 10 grand in a product fee that'll be added onto your mortgage. But if the saving on the monthly payment is so significant compared to the much higher interest rate products out there, then it's worth considering. And especially because the majority of the time you can add the product fees onto the mortgage. So it's not something that you'd need to pay for upfront to pay for the deal and to start the remortgaging process. You can just add it onto your mortgage. And if you're someone who plans to own a property for a long term, yes, no one wants to pay a fee that's quite high, but in the grand scheme of things, if you're going to own the property for another 20 years and you expect the house price to go up 25% during that time, then a fee of 10 grand in the grand scheme of things that makes you remain profitable right now is worth considering. Now, finally, the other thing that you can do to reduce the impacts of high interest rates in terms of how you are buying and selling and owning properties is to buy via a special purpose vehicle. Now, for those of you that don't know what that is, that's a limited company set up with the sole purpose of buying and selling properties. So it's not a trading company set up for any other reason. It's purely to buy and sell properties. And the reason why that can reduce the impacts of high interest rates is because stress testing for limited company SPV applications is far more generous than it is for buy-to-lets in your personal name. So right now, if you were to go and try and buy a property, you might only be able to buy it through a limited company based on the deposit size that you have, compared to trying to raise the same level of finance based on buying the property in your personal name. Now, there are also other benefits about buying through an SPV, namely the amount that you can offset the rental income for tax purposes. So it's definitely worth considering. If you're someone who was always bought in personal names, I would strongly encourage you to now begin to buy through a limited company. It's also possible to transfer properties from your personal name into a limited company without paying stamp duty fees, as long as you own the properties jointly at the moment. So for those sole landlords out there who don't have a partner to do it with, unfortunately, you can't capitalise on this. But for anyone who owns properties, maybe with the partner, the husband or the wife or the business partner, then I would speak to a financial advisor, a tax specialist or an accountant who will be able to give you more information about how it is possible to transfer into a limited company without paying extortionate amount of stamp duty. Now, the next thing I'd like to talk to you about is changing tactics. So now, as Vanessa mentioned, it's becoming more and more difficult to make the traditional buy-to-let model work. And what I mean by that is finding a nice 3-bed terraced house, giving it a lick of paint, new carpets, finding a family, and doing very little work to it and still remaining profitable based on the mortgage interest rates. So one way that you can change your mindset is, instead of focusing on right now, you might be breaking even, focus on the capital growth over time. So if you are looking to expand your portfolio, you might find that no matter where in the country you buy, the rental yield is not that much higher than the mortgage payment. So instead, focus on properties that you know are going to increase in value, or that are most likely to increase in value over time, rather than just the gross rental income that you're receiving each month. Now, secondly, it can be really important, and in my opinion, that the best way to make buying a property right now still profitable is to try and find a property at the best possible price you can, buying it slightly undervalue if possible, and because it needs a lot of renovation. Go on Rightmove, look at the properties that have been listed on there for the longest amount of time. And as Vanessa will know, as the team at VA will tell you, when someone's had a house on the market for 18 months, at that point, they'll probably consider an offer that they wouldn't have thought about even dreaming of accepting 12 months ago, 18 months ago. So finding a property that you can get at the right price with a smaller mortgage balance because you bought it cheaper, and then renovating it to then get it up to the standard to let it, is a way that you can remain profitable. Obviously, that can involve a larger investment upfront than what some of you would be prepared to go for. It's worth considering if you have the financial capability to do so, for sure. Now, as I've mentioned, it can take a lot of cash to go for those types of investments where you need to do a more extensive renovation up front. A lot of portfolio landlords that I'm speaking to at the moment right now are remortgaging their properties despite the high interest rates to release as much equity as possible so that they can move in on properties and buy cash, because cash is king. You know that cheesy saying, at the end of the day, people are much more likely to accept a lower offer if you're a cash buyer and the sale can go through quickly. So if you are able to, now's the time to start looking at your portfolio, looking at how you can free up assets to then make more profitable investments in the next 12 months. And then finally, changing tactics, I'm going to focus on investing in specialist buy-to-lets. So these are things such as your HMOs, your houses of multiple occupancy. As Vanessa mentioned, that's where you rent a room to multiple tenants. You have multiple tenancy agreements on the same property, which means that you then have, instead of one person paying rent, you might have 4, 5, 6, 7, 8, no matter, depending on the property itself. Now, what I would say, if it's your first time looking at a HMO, try to go for an HMO that's got less than 5 bedrooms. If you go for a HMO of less than 5 bedrooms, so 4 bedrooms or less, in a lot of areas of the country, you don't have to license it. So it can remove a lot of the red tape. 5 bedrooms or more, you absolutely have to license it, no matter where you are. But 4 bedrooms, you don't. Also, if you go for a HMO setup, there's a second specialist buy-to-let type, which is called shared accommodation, which is very similar to a HMO, apart from it's up to 4 people, 4 tenants in the property, all on the same tenancy agreement. So it's not technically a HMO because there's not multiple tenancy agreements, but there's multiple people and therefore multiple revenue in the property. A lot of the large buy-to-let lenders, a lot of the brands that you'll all know and probably have mortgages with, such as Barclays, Birmingham Midshire, some of the largest buy-to-let lenders in the country, will allow shared accommodation on their standard mortgage products. So you don't necessarily have to go onto a higher interest rate or a specialist product to be able to then increase the rental yield and therefore profitability of your property. There are, of course, certain regulations that you need to meet. So do your research, speak to a broker who'll be able to guide you through what those regulations are. Or speak to an agent such as VA who will be able to talk you through that. But it certainly is one to consider. And then finally, we've got multi-unit freehold blocks. Now, this is slightly different to a HMO in that it's splitting a freehold property. Let's take a 2-up, 2-down terraced house. It's splitting it into 2 flats, or as many flats as you can fit into that one house. Now, each flat needs to be completely self-contained. So what I mean by that is they need to have their own kitchen, their own bathroom, their own utilities, so their own boiler. They need to be completely self-contained so that if you wanted to sell one of those flats, you could split the title, create a leasehold and sell that flat on its own. But at the point when you buy a multi-unit, they're all on the same freehold. So it's not buying flats individually, it's buying one block with multiple flats in it. Again, because there's multiple was multiple properties now instead of just one. That's multiple tenants and therefore multiple revenues and high profitability. And then lastly, the final specialist price outlet I want to talk about is short-term rentals. So holiday lets, Airbnb, booking.com, that kind of scenario. Now, this is the more specialist in terms of financing, because there's not as many lenders that lend to Airbnb and holiday lets as there are to the previous specialist buy-to-lets that I've just spoken about. It's a slightly more riskier proposition, I would say, because there's no guarantee that you'll always be able to keep the property occupied. However, it's definitely one to consider, especially if you've got a property that is in a holiday destination, whether that be the Lake District, the seaside, big cities that, you know, that people often want to come for city breaks on. If it's in one of those locations, then short-term rentals can do really well, but I'd maybe avoid that type of specialist buy-to-let if you've got a property in a average town in the majority of the UK, because where I live, in a little town just outside of Hull in East Yorkshire, people don't come here for holidays that often, so the chances are you'd struggle to keep it tenanted 100 or 365 days a year or as close to. Now, here is an example of the difference of the rental income. So if you've got a traditional buy-to-let, let's say, let me just go take you back a slide there. So with a traditional buy-to-let, say a 3-bed house, you're renting on a single tenancy agreement for 1,500 per month. If you were to convert that to a HMO, and you would convert it to a 4-bed HMO by reducing the size of the living room, for example, splitting it and putting in a 4th bedroom downstairs, which is really common for a HMO property, you could then rent that out for approximately £550 per room. That's £2,200 per month as your gross rental, with the additional £700 a month. Now is the time to really consider looking at strategies like this if you've got an underperforming property that right now you're either breaking even or you're making a loss, especially if you don't have tenants right now. If you're without a tenant, it's the time to reevaluate your plans for the property and start considering looking at a specialist property such as a HMO or shared accommodation. Or secondly, looking at multi-unit freehold block. So this is an example of a multi-unit block that's been split. And you can see on the left-hand side is there a 1-bed flat on the ground floor, and then on the right-hand side is a 2-bed flat on the floor above. By converting it to flats, depending on which area of the country you are, the condition of the flat, and a few of the factors, let's say on average you could get £950 for a 1-bed flat. Apologies, the top row should say one times 1-bed flat for £950 a month, and then a 2-bed flat for 1,200. In total, that's £2,150, which is £650 more a month than we looked at for the average 3-bed house. Now, if it's possible in the space, and if it's right for the market that you're in and the location of the property, if studio flats are popular in the area that you are, again, in big cities, these can be really popular and quite sought after, then you'll make even more money converting it into 4 studio flats. So that's £750 each, roughly, for a studio flat, depending on the condition of the size. In total, that's £3,000 a month as the rental income, which is double, 1,500 more than renting it as a standard 3-bed house. Now, I appreciate not everyone has the funds to go into a house and convert it into 4 flats, but right now, if you're deciding between buying another property or using the funds that you have right now to convert an underperforming property, then it might be worth you using those funds to convert a property into either a HMO or a specialist buy-to-let, such as a multi-unit block. What I would say is before you venture into doing this, first of all, speak to someone who knows the local market well, someone such as Vanessa and the team at VA. Speak to them and see in the area of this property what performs better, HMOs or multi-unit block. So renter rooms or one bed flats, because what can happen is people can hear the amount of revenue that HMOs, for example, can generate, and suddenly there'll be lots of HMOs popping up in a very small area. In Hull, near to where I live, that's happened. There's a university in Hull, so I think a lot of investors came here and invested quite a lot of money in the cheap houses because house prices are relatively low, converted them to HMOs, and now if you go onto Rightmove and go to rent a room, there's 50, 60 rooms that are vacant. So in that scenario, you're better off going for a multi-unit block. If you're somewhere where single rooms for rent are few and far between and they're in high demand, then you do very well to go and convert a property to a HMO. Now, I hope that has all been useful. I hope I've given you some insight onto the different types of properties out there from the specialist point of view, and also the options out there. Now, moving forward, I'd really recommend that if any of you are looking to change your mortgage or buy a new property, or your rate is coming up for renewal in the next 12 months, instead of just going online, and especially if you've got a buy-to-let, instead of just going online and going on a comparison website, speak to an advisor. A lot of the mainstream buy-to-let lenders who are really good for buy-to-lets do not lend to you personally. You have to go through a broker. So the rate that you get on a comparison website will not always be the cheapest out there. So by all means, do your own research, and if you find a better rate online, go for it. But a lot of the time, you might be able to get a better interest rate from a broker, and one that you're actually qualified for as well. So it's definitely worth speaking to your broker or getting in touch with myself. We'll be able to talk you through your options. Secondly, I'd encourage you to change tactics. As I mentioned, look at the more specialist buy-to-lets and focus on a long-term approach of increasing or buying properties that will have that are expected to have a larger increase in value compared to just the rental yield right now. And thirdly, most importantly, prepare for opportunities. So if you are able to get yourself in a position right now where you have cash ready to go so that you can make a bold offer and buy a property at a better price, then that will be the best thing that you can do. What I always say to my clients is that even when interest rates are high, if you can get a property in the right location at the right price and it's the right investment, then it's still absolutely worth you going for it. I'd much rather encourage people to stomach high interest rates for a couple of years and get a really good property than, as what happened during the end of COVID, interest rates were still relatively low, but people were buying properties at really inflated prices, a lot higher than what they were worth. That's a much worse investment than going for a property right now that's a good price with a higher interest rate. So prepare, speak to your advisor, see if there are any funds that you're able to release from your portfolio, and get ready to capitalise on the opportunities that are set to come in the next 18 to 24 months. Thank you all for listening. I hope that has been helpful, and I will open the floor to any questions at the Q&A, and we'll look over the messages in the chat box. So I'll just stop sharing my screen in a moment.
That's great. Thank you, Megan. Thank you so much. That was great. A lot of information and numbers and strategies there. There's lots of questions that have been coming through on the chat. So we've got about 8-10 minutes. So I will pick as many questions as I can that I think that we will benefit from as the majority. Megan, have you stopped sharing screen? That's it.
I should have done now.
Yep, that's all good. We're back on the whole screen. So just to say though, before I go through a couple of questions on the Q&A, thank you for staying to this point of the webinar. In the chat, we're going to drop some contact details or contact link actually for Megan. So if you're interested in talking to her about something very specific, there is no obligation, as she has said. Feel free to click on the link, and you can arrange a nice call with Megan there. And as we said at the start of the meeting, we are giving a free home buyer's guide, which we wrote probably 6 months ago, and we've updated it in terms of the best places to buy, nuggets in Luton. So if you're a local landlord or you're interested in the Luton market, we're also going to drop that for you free in the chat. It's a free downloadable ebook, and it's quite useful for either current investors or new investors looking to come into the Luton Bedfordshire space. So please do take advantage of that. And now I'll quickly move on to a few of the questions at random, no particular order. So we have a question here, Megan, for you. Linda wants to know what does the product fees on a fixed term for a residential property look like on average at the moment?
So residential fees have maintained the same level they typically have done for quite a few years. So it's less common to see a percentage interest rate fee for a residential property. I'd say typically on a residential mortgage, you're looking at a product fee of 995, which is fairly standard. It's been the industry norm, I'd say, over the past few years. But depending on your mortgage balance, Linda, it might not be best for you to go for a product with a fee. Sometimes it works out cheaper overall to go for a fee-free product, but it really depends on how much is outstanding on your mortgage and how long's left on the term. But an advisor will be able to tell you what's cheapest for you overall, rather than just the lowest rate with the fee.
Another question here from Ruth, she's asking, how do you redistribute mortgages across a portfolio?
So there's a couple of ways to do this. So the most common way is to remortgage a few properties at the same time. I'm currently doing this for a couple of landlords that I work with, where we're submitting 5 or 6 applications concurrently to the same lender normally to make it a little bit easier. And they will then, say for example, one house currently has a mortgage of 100,000, the other one has 200,000. You'd then remortgage each house for 150,000, and they'd all complete on the same day. So on the same day, the solicitor would release the funds, and the right mortgage and the right lender would get paid the right amount, and it would redistribute and balance the mortgages out.
Great, thank you. A question here from Vivian. She's asking, can you set up a UK limited company if you're based overseas? So if you want to buy a property and you're not based in the UK, how simple or how complex is it to go about setting up a limited company to purchase?
Yeah, it's definitely possible. It depends which country you're in, for one. So each lender who allows applicants from overseas will have criteria about which countries they'll allow you to live in. If you live in a country that is on the financial sanctions list, that's when it's really difficult, and there's not many lenders who will do it. But if you live in a standard overseas country where there aren't any of those issues, then there are quite a lot of lenders who will lend to a limited company where the directors are abroad. You'll be looking at higher interest rates, so you won't be able to go for the most competitive deals out there, but it is still possible. And again, speak to a broker who will be able to tell you what your options are if that's something that you're considering.
Great, thank you very much. Question here from Raz. I think we looked at this just before you closed. Raz is asking, what are the most creative strategies to generate a 10% return on investment, given that buy-to-let in the current interest rates won't yield more than a 4 to 5% ROI? I think, Megan, I'll pick up a little bit on this here, because you touched on this in your, I think, in the one before your last slide. So I think, Raz, yeah, like Megan said, yes, the traditional way of renting properties at the moment with the current interest rates, the yields are a bit low. So yes, it would be very much looking at, we talked about the HMO option. I don't know whether you're an experienced landlord, you have HMOs. Obviously, there's different compliance, there's licensing that's involved in that strategy, but it's like what Megan said, it's now, as investor landlords, it's looking at those types of rental returns. And so if you want that higher return, I mean, 10% is amazing. I don't think I've seen anyone achieve a 10% rental return for a very long time. But if you're looking at pushing upwards of 5-6% on your rental return, you will have to look at the HMO strategy. I know Megan talked about trying to work with the 4 beds and less, so that you don't get tied up in as much compliance. That varies from borough to borough, so you have to be careful. You have to look at your local borough to see what does constitute a HMO property. But that certainly would be one. I mean, room rates now in Luton, for example, on HMOs, you're looking at upwards of 550 for a room. If it's a modern property with an ensuite, I've seen some go for as much as 650, 675 for a double room with a nice ensuite. So on a 5-bedroom, 6-bedroom HMO property, then depending on what your costs are, you can be looking to break that 4-5% return on investment, Raz. So You have to be game for everything that comes with that. But those are the ways. And like Megan also said, taking properties and converting them so that you get more units out of one plot. I think that's the way, depending on your appetite for risk and your experience in property, that's the way that as a landlord now you would be looking at achieving higher than normal rental returns. Megan, would you add anything to that?
The only thing I can think of is changing the location of the properties that you're buying. There's a reason why a lot of landlords now are going up north to Manchester, Liverpool, Newcastle. The ROIs on properties up north are a lot stronger. So yes, you might not have as much control in that you would struggle to manage the property yourself, and you'd need to have a trusted lettings agents up there to do that for you. But the returns can be a lot higher. So that's something again that I'd consider is changing the location and not just going for something local to you, because just because it's local and it's easy doesn't always mean that it's the best investment.
Yep, I would, well, would I agree with that? Would I agree with that? I would agree with that, but I think that the only thing is when you're invested much further from where you're locally based, you would need to employ, I would say, the assistance of a good agent, because
Yeah, for sure.
properties, yeah, 200-300 miles away or 80 miles away from you, it's not going to be an easy fix to run there if something goes wrong, or all the backwards and forwards. So you almost need to set it up in a way that, you know, you have a good agent, you have good contractor network, so that you can almost to a degree set it and forget it. Otherwise, you will be stretched and you will be stressed. So again, it all depends on your current lifestyle, what you do, how much time you have. So yes, further afield is great because, but you know, buying into the market may be cheaper, but obviously you've got to think about all the logistics that it takes to run, manage, and rescue that property when situations occur. So there's always the other side. But yeah, Megan's right. And I think with that, we pretty much are pushing our time limit. Don't want to creep into too much more than what we said. So I will bring the webinar to a steady close now. First of all, just to say thank you for everybody for logging in and staying with us to the end. A very big thank you to Megan. Thank you, Megan, for being our VA expert. You delivered a fantastic presentation with lots of information and nuggets for us to all take away and work with. We have dropped a couple of links in the chat earlier. If you weren't looking through the chat, there's a link in there for contact with Megan if you would like that. There's also a link if you don't know how much property is currently worth. It doesn't have to be a rental property. It could be the property you live in. There's an instant valuation tool that we have at VA. You just literally pop your details in for your property, less than 60 seconds, and it will give you an estimated valuation of what your property is worth today. Because of course, with mortgages and remortgages, you need to know your property's value before you can start looking at what options you might have. So that's in the chat for you, as well as our free home property buyer's guide for Luton. So those links are in the chat, and we'll also send them out via email over the next couple of days to everyone who registered for the event. So thank you for attending. Please stay tuned to our emails, our social media. We're on Instagram, we're on LinkedIn, we're on Facebook. We'll be back in 2024. I can't believe we're almost approaching another year. But VA will be back in 2024 with another series of what we call our VA expert webinars on tax, on finance, on mortgages, on conveyances. And if you have topics, if you have areas of your property business that you would like us to talk about, feel free to drop me a line at VA. We're always open. We're always looking for new topics, and we've got a massive pool of experts that we work with and we have good relationships with that we would like to bring to the platform to, you know, to give you what you need and what you want to hear. So please look out for our next expert webinar, approximately around the end of January, February. And I think with that, I wish everybody a good night and a nice finish to the week and a good weekend ahead, whatever we do. Thank you very much for joining the call.